Welcome back. As a result of the quite disappointing non-farm payroll report earlier today, the Fed fund futures have moved. This is where we stood just a few days ago, November 1st. The black line represents the chances that the Federal Reserve will raise interest rates. The best chance of that was January 31st meeting. That was a 30% chance of an interest rate hike. The chances that the Federal Reserve will ease interest rates, will lower interest rates, the first time that is above the 50% level is at June, on the June 12th meeting at 70%. Now, 30% in January, 70% in June. That was as of a few days ago. This is where we are now. There's now an 11% chance the Federal Reserve will raise interest rates in January. That dropped again from 30%, now 11%. The chances the Federal Reserve will ease interest rates, the first chance that they will ease interest rates and that probability stands above 50% is the May meeting. That's at 64%. It was at 70% in June. It is now 64% in May. So we've moved definitely more towards a bias of lowering interest rates sooner than expected. And the chances of raising interest rates is less now. 30% is now 11%. This is where we stand in terms of the economic calendar in the month of November. Well, actually, the FOMC meeting started October 31st. We had a 69% chance the Federal Reserve would raise interest rates. To keep interest rates unchanged at the 525 to 550 level. The chances of an interest rate hike, the red histogram bar 550 to 575, we had 69% and 31%. But now we have a 95% chance in the next meeting, in the November meeting, the Federal Reserve will not raise interest rates. The blue histogram bar indicates that chances will stay at the current 525, 550 range. That's at 95%, up from 69% just the other day. And this was in large part due to a disappointing jobs number, which basically gives the Federal Reserve reason not to raise rates because the jobs market does not look good, and moving closer again to the possibility of reducing interest rates because the jobs number doesn't look good. Today's change in Treasury bonds is all down. The long-term bond yields have gone down the most, 21, 22 basis points on the 7, 10, 30 years. The short and medium terms down, but to a lesser extent. Current U.S. Treasuries stand as we see here. The short-term rates, 552 on the 1 month, 556 on the 2 month, all the way through the 6 month, even the 1 year is above 5%, much higher than the 467. If you recall the other day, the 467 percentage rate paid on the 10-year Treasury note was higher. It's lower down. Why? Because the long-term bonds are selling off. Well, the long-term bonds are rallying. Their yields are selling off. The long-term 2-year, that's medium term, down 1.4% in the past month. The 5 years down 1.5% in the past month. These are the percentage changes on their maturity, on those specific yields of each respective maturity. So we see that the real move in the fixed income market, especially over the past day or so, has really been on the longer side of the spectrum. Now we see here the red line is a 1-year U.S. Treasury notes. That's the yield that currently stands around 540. The 10-year is the black line. The blue histogram bars represent the S&P 500. Today, the black line has dropped. The 10-year yields have dropped a lot more than the 1 year. What this is telling us is the anticipation for a long-term economic stability, the long-term economic strength that has diminished to some extent because, again, non-farm payrolls were just so disappointing. And as a result, the stock market is up. The blue histogram bar shows us today's move in the stock market, and it's to the upside. So the stock market likes the chances the Federal Reserve will not raise rates. It likes the idea that the Federal Reserve is closer to reducing rates than raising rates to be certain. So with that said, what's working for the stock market in one direction is working for, well, the bond market actually in the same direction, but the yields moving opposite, of course. So With that said, we want to look to any new economic number coming up next week. We have a ton of stuff going on. And we want to see especially how the market reacts. If it's a good number, does the market ignore good news or does it pay attention to the good news? Does it react to the good news? And conversely, with negative news out there. But right now, at least as a result of the non farm payroll number earlier today, the Fed fund futures have moved away from a bias of raising rates and a little bit closer to the idea about cutting rates. Not now, but the best chance, at least above 50%, is in May. So certainly a change in the trend, a change in the dynamic. Stay tuned. Also, tomorrow we have a really exciting discussion in response to a viewer's question. It was an excellent question in regards to the bond markets, the inverted bond market, and the dynamic between that and the Federal Reserve. So stay tuned for that. That will be here tomorrow. We hope this has been helpful. We look forward to seeing you back soon.